Markets are rethinking the path of interest rates after Friday's blowout U.S. jobs report. Joining us now to discuss how things may play out and how investors may want to be positioning themselves is Jeff Evans, VP Director and Lead of Empirical Research and PM Support at TD Asset Management. Great to have you back on the show, Jeff.
Thanks for having me here. It's always a pleasure.
So always with these data points, we can see a switch in the narrative, a switch in the story. You get this blowout numbers from the U.S. labor market, much stronger than the expectations were, and now we have to reevaluate what we're thinking about the entire macro environment. How do you see it?
Absolutely. It continues to be an incredibly volatile year, and particularly on these rate cut or rate hike expectations, it just continues to be one of the key drivers of markets. It's not even the actual rate cuts themselves, it's just the expectation of what the Fed may or may not do. If you look at what's changed since Friday, when the market was expecting basically 7 rate cuts from the Bank of Canada and the Federal Reserve over the next 12 months, we've seen about 2 of those cuts now being taken out of next year, probably pushed into 2026. And that's probably not unsurprising to get to a point where we're effectively getting back to a neutral interest rate by the end of next year. We're starting to get a little bit aggressive, so not surprising we saw a little bit of that dialed back. But again, it continues to create lots of volatility and chop in the markets. I think the key thing to keep in mind here is that the Fed is still very restrictive in their monetary policy. So you've seen a 50 basis point reduction, you've seen a couple of those from the Bank of Canada and other central banks as well, but we're still at levels that are generally shrinking the economy, reducing inflation and economic growth over time. And so the Fed still does have a need, and central banks as well, to bring interest rates back to that neutral level over time. It's really a question of how fast are they going to do that. And so then in the backdrop of that, it becomes a question of how do we position our portfolio and at least in the context of our team, where we spend a lot of time thinking about styles and different groups of stocks, what's the best environment for things like value versus growth, high profitability companies with dividend yield, and so forth.
All right, let's talk a bit about that, because I know you have your empirical research models. What are they telling you in terms of positioning?
Perfect. So let's start with a longer term view. If you kind of ignore the cycle for a second, just take a long term view on what works over 5 to 10 years, it's typically high quality, profitable companies, usually companies that have some growth opportunities, and then ultimately companies that can allocate capital optimally between that growth and then also returning some of that capital to shareholders through dividends and share buybacks. If you can get those companies at a reasonable price, even better. What happens over time, though, is that as you move through the cycle, central banks are raising and lowering rates, economies moving from shrinking to growing, the weight that we put on some of those attributes changes over time. If you're in a rate hike cycle, the way we were a couple years ago, what the Fed is trying to do is slow the economy down and bring down growth. If you're bringing down growth, you're bringing down earnings growth as well. And what that ironically tends to mean is that investors gravitate to growth stocks. And it's just supply demand. If there's fewer growth stocks in the market, investors will tend to put more value on whatever's left over. So in a rate hike cycle, you tend to see growth doing well, and then usually a concern on profitability or focus on profitability. As that flips around and central banks start cutting interest rates, it's basically the opposite. You'd start to see a rotation out of the high growth, high multiple names. Valuation becomes a lot more important in that environment. Now again, the critical thing is the Fed adding stimulus to the economy, or are they just dialing back some of the restrictive monetary policy? If it's, if rates are going to 0 or 1%, if this is full on stimulus, that's when you would lean into value, small cap stocks. That usually is what tends to get that sort of segment of the market going. I don't think you're going there anytime soon, and the Fed is even saying that in their SEP. This is going back to neutral, taking accommodation out. So I think the strategy is stay with high quality, profitable growth stocks. It's just about being more discerning on valuations at this point in time. The other thing that's interesting with this cycle too is that over the last couple of years, investors have had a lot of opportunity to put their money into low risk GICs and high interest savings accounts. It's probably been 15 years since you've seen GICs at that level. That is starting to unwind. And as that does, investors are either going to have to accept a lower return from those safe assets, or more likely some of that probably flows into some of the dividend yield segments of the market. And so what we'd expect over time is that value stocks should do well, but also stocks with sustainable and quality dividends should tend to have the advantage as well.
Okay, so that's a nice landscape out there for us and what's going on, the big macro picture. When we talk about interest rate policy, obviously there are certain sectors of the market that are very sensitive to that. I can't think of any better poster child for that than real estate. What are you seeing in that space?
Exactly. So real estate's probably, if you go down all of the sectors, probably one of the most interest sensitive. Not surprising given that the quality of the cash flows allow them to run a little bit more leverage than other sectors. That tends to be good over the longer term, but when you get these little rate hike cycles and rate cut cycles, you tend to have that interest rate effect dominating a lot of what's going on in real estate. It's been a tricky year for a lot of or tricky 2 years for a lot of these stocks. As interest rates have come up, it's had a couple of implications. The first is that debt gets more expensive. So a lot of these real estate companies are still, they have fairly full portfolios, lots of occupancy. They're getting rent growth. Unfortunately, that rent growth is being eaten up by higher interest costs over time. Now that we're kind of going in reverse, you can actually start to get some of that rent growth translating into cash flow growth again. There still may be a little bit of debt resets over the next year or so. Lots of companies issued cheap debt in the depths of the pandemic or even pre-pandemic. As that rolls, it's still going to be another year or two before you can sort of fully get through the interest rate headwind. But we're getting to a much better position where companies can actually capture that rent growth. The other thing that happens is you actually start to see better tenant health over time. So one of the issues in the last 2 years, companies have not been willing to take office space, lots of uncertainty on how the economy is going to pan out. You've seen some uncertainty on whether people are willing to take a lease on an apartment or just other segments of real estate. I've also seen it in industrial logistics where there's just, with economic uncertainty, we don't know if people are buying or selling. Companies are much less reluctant or much less willing to take industrial space as well. So the underlying assets are performing well. But as interest rates come down, you get a little more certainty in how that's going to perform. You can start to see leasing activity pick up over the next couple of years.
Another interesting part of the market and an interest rate sensitive, because I think about the cost of capital projects for these players. Infrastructure names, what's it looking like there?
So infrastructure is a little bit different. And a lot of if you're thinking about utility stocks as kind of one of the core infrastructure assets, they tend to have a pass-through mechanism. They're highly regulated. There's usually a very complex formula on how they can get to their implied or allowed returns. And interest rates are a portion of that. When rates are going up, usually that means the utility cost of capital is going higher. And over time, usually that flows through into slightly better profitability or earnings growth. They can usually recover that interest expense. Unfortunately, as interest rates come down, that actually can change some of those formulas. And so what you've seen over the last couple of years is actually the allowed ROEs in the utility space come up to reflect a higher cost of capital. We may get a little bit of a reversal of that. Again, in a lot of cases, these are multi-year rate cases that happen, so it'll play out over time. Really depends on how fast and how deep some of these rate cuts are. At this point, I don't think we're going back to the 0 to 1% interest rates. And in that scenario, should be a reasonably favorable backdrop for utilities. I think the bigger story is just the underlying load growth in that space. We continue to see enormous demand from data centers and actually some of the strongest electricity growth that we've seen in decades. And that's really the important story for utilities. There may be a little bit of a shift on interest rates in the near term, but the longer term demand for electricity in the United States and Canada continues to be very robust.
I want to circle back to the top with something you just said in terms of, doesn't seem like we're going to go back to like 0% interest rates, which we were at because of the dislocations of the pandemic. Given what happened on Friday, stronger than expected U.S. jobs report, recalculations in the market with the Fed policy, overall, the market still thinks we're on a cutting path, an easing path.
Exactly, and I think the big change, if you're to, again, look at how the market expectations changed from 7 o'clock on the morning on Friday to 10 o'clock, it was basically taking 2 rate cuts out was what's happened, and not actually taking them out, it's just pushing them further in time into 2026. So the market still expects rates to come down. The key is this sort of concept of R star, that neutral interest rate that the Fed chairs have talked about over time. If you look at where that was pre-pandemic, it was probably 2.25% to 2.5%. The risk was that was actually going lower, and so it might mean that interest rates would have to be structurally lower. What the pandemic has done is it's actually kind of shifted that discussion a bit, that maybe the neutral rate is more like 2.7, potentially 3. So we may be in an environment going forward where rates are higher than they were in the pre-pandemic environment. But we're talking 25, 50 basis point variations. It's not 3 or 4% changes in interest rates. I think the other key thing to keep in mind with the jobs report, this is a notoriously volatile data series. It's prone to a lot of revisions over time. And I think the key thing isn't really to focus on a single data point. It's averaging out the data over an extended period of time in several months. What we're seeing, if you look at average job growth over time, it's telling us we have a robust U.S. economy. And then what's interesting is when you start comparing the U.S. to other countries. Canada is a good example. We've got some data coming up on Friday. The unemployment rate in Canada has moved up into the 6.5%, 6.7% range. And so the U.S. is still a bit of an exception. You're starting to see weaker unemployment data in Canada, starting to go into Europe. The ECB was expected to stay flat in October. You're now even seeing talk that they'll probably cut this month. So things are changing in other countries, and if you keep in, take a global perspective, the U.S. is still strong. Broader backdrop is that you should continue to see rates come down across most of the developed market economies.